I think our core position is that it'll be 25, but I think there is a lot of work to do. I think the first thing you got to say in the UK, and you got to recognise it, is the economy has been much stronger than a lot of people have been expecting. But in a sense, that's part of the problem. In particular, Labour has been able to reassert its strength. You're increasingly seeing, what were considered one-off wage deals becoming more embedded, and you saw the wage data last week that is supporting that. So I think the problem that the Bank of England faces, obviously, is that you have a very, very strong economy. There's also some other things. There's a lot of noise around mortgage rates and what it will mean. But obviously, the thing that people sometimes miss is you now in the UK have a situation where more than half the household stock are owned by people who don't have mortgages. And those that does have mortgages, a lot of them have been fixing. So it's not transmitting in quite the way it used to before, which means things will have to keep hiking potentially to bring things under control.
I remember when I was covering the Bank of England at the last monetary policy report, there was a section, and we're getting quite granular here, but a whole section on how the state of the housing market today is very different than how it was in the early 90s, to your point, which is why they seem a bit blasé about it. But I want to go back to just what is priced into the market here. It's pretty astonishing that the market is pricing in a terminal rate of 5.75% out of the Bank of England in February. When I was talking about the reaction in pound sterling, I did note that if you had bought the pound back in October post the mini budget crisis, you would have made 20%. Sometimes it does pay to be contrarian. Will it pay to be contrarian, do you think, in front-end UK rates? Is it time to buy the front end of the market?
I think it's a very tricky one. I mean, an awful lot is priced in, and I think we have been in a number of our solutions underweight rates, but it's much less obvious now than it was before. I think the focus may well be slightly at the more longer end where we think things are interesting. So the way we are looking at it in our portfolios in particular is probably cautious enough on the rate side, maybe short duration if anything. But in particular, maybe looking at where real rates are going to go, and in particular looking at break-even inflation. And I think that even there, though it's higher than many other economies, it may well be that is still under-predicting where break-evens are going to get to. And so therefore is where there's potentially the ability to play the curve in a more interesting way.
Niall, I want to broaden this out actually quite a lot and ask you about your view of risk parity strategies here. Is this an environment where those types of strategies can work? Because it is surprising that the S&P is actually sitting at a more than 1 year high now, and fixed income markets, well, they've been selling off, but as we've just discussing, there might be a ripe opportunity to start getting involved on the long side.
Yeah, I think generally one of the big issues has obviously been that while you can look at a number of reasons why you would expect markets to be a little bit weaker, the broader equity markets, you've rightly highly pointed out, have been doing very well. I talked about this recently in a blog I wrote, kind of the idea between tactics and strategy. I think it remains the fact that we look at things and consider that the equity markets remain vulnerable. However, there are some very strong forces driving things in the shorter term, in particular that AI growth story. And so therefore you have to position yourself for that on a shorter term. I think your point on effectively looking at interest rates as part of that would be reflected in our positioning as well. We've seen interest rates as being very range bound over the course of the last number of years, or the last number of months, and we're certainly moving up to the upper ends where we would think to ourselves it makes sense to start positioning yourself long duration or owning bonds on a relative basis. But what I think is also interesting just to say around that, that's probably more a comment on government bonds and investment grade duration. If you also note, in line with that risk appetite you spoke about, high yield bonds have done very well over the last number of months. And so we'd be looking at that again a little bit warily and wondering whether the spreads have tightened to a point where it's not obvious that you would want to be increasing your allocations here.